There is a particular kind of anxiety that shows up late at night, the kind that does not announce itself loudly but settles quietly into your chest like a cold stone. You have spent 30, maybe 40 years doing everything right, working, saving, sacrificing smaller pleasures for the promise of a comfortable future, and now all of that accumulated effort, all of that discipline sits inside an account at Schwab or Fidelity or Vanguard, and then one Tuesday morning you are drinking your coffee and a headline flashes across the screen. Another major financial institution has collapsed. Your finger hovers over the remote, your stomach tightens, and the question you have never allowed yourself to ask out loud suddenly becomes impossible to ignore. What would actually happen to my money if Schwab, Fidelity, or Vanguard went under? I want you to understand something before we go any further. That question is not paranoid. It is not the product of an overactive imagination or an excessive fear of unlikely scenarios. It is the single most important financial question a retired person can ask in today's environment, and the fact that most financial media refuses to answer it directly, clearly, completely, without burying the answer in legal jargon, is an embarrassment to this industry. After the collapse of Silicon Valley Bank in March 2023 and the rapid failures of Signature Bank and First Republic that followed in the same season, millions of Americans who had worked their entire lives to build financial security began asking their advisors, their children, their accountants, could this happen to the firm holding my retirement? And far too many of them received answers that were vague or rushed or technically accurate but emotionally useless. So today, we are going to answer it properly. We are going to walk through exactly what the law says, exactly how your money is held, exactly what the protections are, and exactly what would unfold step by step if one of these giants ever found itself in serious financial trouble. By the time we are finished, you will not need to guess. You will not need to take anyone's word for it. You will understand the mechanics clearly enough to make your own informed judgments. And that understanding, more than any specific answer I could give you, is where your real peace of mind lives. This matters more for seniors than for any other group of investors, and I want to be direct about why. A 35-year-old who loses access to their brokerage account for 2 weeks during a chaotic financial transition faces inconvenience. A 72-year-old who depends on that account for monthly income, for medication, for the stability of a life carefully constructed over decades, faces something categorically different. The stakes are not abstract for you. They are concrete and immediate, and you deserve concrete and immediate answers. I also want to name something that the financial media rarely acknowledges honestly, the way banking news and brokerage news gets reported, as if they belong to the same category of risk, has done enormous damage to the financial confidence of millions of retirees. When Silicon Valley Bank collapsed, the headlines did not say a bank with a specific and unusual set of vulnerabilities has failed. The headlines said the banking system is in crisis. That framing, panic-oriented, imprecise, driven by the logic of clicks rather than the logic of analysis, left countless people wondering whether the same forces that brought down SVB could bring down the institution holding their life savings. The honest answer is no, and understanding why requires us to look very carefully at something most financial commentary glosses over entirely: the fundamental structural difference between how a bank holds your money and how a brokerage holds your money. Everything begins with one distinction, a distinction so fundamental that if you understand nothing else from this conversation, understanding this will still transform the way you think about your financial safety. A brokerage firm and a bank are not the same thing. They do not hold your money the same way, they are not governed by the same laws, and they do not carry the same risks. Treating them as interchangeable, as many people do, is the root of almost all the anxiety we are here to address. When you deposit money into a bank, a checking account, a savings account, a certificate of deposit, that money becomes part of the bank's balance sheet. This is not a minor technical detail. It means the bank legally takes ownership of your funds and records them as a liability, money they owe you, but money they now control. They take that pooled deposit base and they go to work with it, making car loans, commercial loans, mortgage loans, investing in government securities, running their business. The deposit you made on Monday might be part of a business loan extended to a restaurant on Wednesday. Your money and their operation become intertwined. That is precisely why Silicon Valley Bank collapsed when it did. They had taken depositor funds, invested them in long-duration bonds, interest rates rose sharply, the value of those bonds fell, depositors panicked and withdrew en masse, and the bank could not cover the outflow. Your deposit was genuinely at risk because the bank had genuinely used it. A brokerage firm operates on an entirely different legal foundation. When you open an account at Schwab and purchase shares of an index fund, that money does not go onto Schwab's balance sheet. It does not become Schwab's asset to deploy, lend, or invest as the company sees fit. Federal and state securities law explicitly and strictly forbids it. Your investment dollars belong to you, and the law treats them as yours from the moment you commit them. Schwab manages over $9 trillion in client assets, and none of that $9 trillion appears as a company asset on their financial statements, because none of it belongs to Schwab. It belongs to millions of individual investors whose instructions Schwab is simply executing. Here is the image I want you to carry with you. Imagine you have a storage unit at a large facility. The company that owns the building takes care of security, lighting, the locks on the doors, the insurance on the structure, but everything inside your unit belongs entirely to you. If that storage company filed for bankruptcy tomorrow, their creditors could come after the building, the equipment, the company vehicles. They could not walk into your unit and take your belongings. Your property is yours regardless of what happens to the business that manages the facility. That is almost precisely how a brokerage works with your investments. There is one critical scenario where this protection breaks down entirely, and it is important enough that I want to name it clearly. The entire system of investor protection rests on a separation between the person managing your money and the institution physically holding it. The moment those two roles collapse into one, when the advisor and the custodian are the same entity with unchecked access, you become vulnerable in ways that no regulation can easily prevent. This is precisely what made the Bernie Madoff fraud possible. Madoff acted as both the investment advisor and the custodian of his client's assets, meaning he had complete, unsupervised control over funds he was also claiming to invest. There were no independent eyes on the vault. If you ever work with a private investment advisor, the single most important question you can ask is this: where exactly are my assets held and who has independent oversight of them? If that advisor ever suggests that he or she should maintain direct custody of your money, that is not a small red flag. That is the red flag. Understanding that your brokerage does not own your assets is the foundation, but the protection does not stop there. The financial system has built several additional layers of security around your investments, and each one serves a different purpose. The mistake most people make is assuming their only protection is an insurance policy, something that kicks in after disaster has already struck. In reality, the most powerful protection happens long before any crisis reaches your account, and it is structural rather than reactive. The first and most important layer is the use of independent third-party custodians. When you invest in a mutual fund or an ETF, whether it carries the Vanguard name, the Fidelity name, or the Schwab name, the actual securities underlying that fund are not held by the company that manages it. They are held by a completely separate financial institution whose sole legal responsibility is to safeguard those assets on behalf of the fund's investors. Schwab funds, for example, use State Street Bank and Trust as their custodian. Vanguard explicitly states in its regulatory filings that the securities underlying its funds are held by a custodian, not by Vanguard itself. Dimensional Fund Advisors uses Citibank as the custodian for many of its ETFs. This is not a preference or a best practice, it is a legal requirement, and its purpose is precisely to prevent any fund company from having unchecked access to the assets it manages. One important nuance worth naming here. Charles Schwab operates a banking subsidiary called Charles Schwab Bank, and money deposited into that bank in a savings account, a checking account, or a bank certificate of deposit is subject to FDIC rules, not brokerage rules. The FDIC insures up to $250,000 per depositor per institution. If you are a Schwab client, it is worth knowing clearly which of your accounts are held at the brokerage and which are held at the bank, because the protections governing each are entirely different. The second layer is the Securities Investor Protection Corporation, known as SIC. Think of SIC as the FDIC of the brokerage world. It was created by Congress in 1970 specifically to protect investors if a brokerage firm becomes insolvent. SIC covers up to $500,000 in total securities per account, including up to $250,000 in cash. What SIC does not cover is equally important to understand. It does not protect against market losses. If your portfolio declines in value because the stock market falls, SIC offers no remedy. What it protects against is the specific scenario in which a brokerage firm fails and client assets go missing, either through fraud, misappropriation, or the chaos of a disorderly collapse. In that scenario, SIC steps in to recover and return your assets, up to its coverage limits. The third layer is one that most investors never hear about, but that the largest firms quietly maintain excess private insurance coverage above and beyond SIC limits. Fidelity, Schwab, and other major institutions purchase additional coverage through private insurers, When evaluating where to hold your assets, it is worth confirming with your specific brokerage what their total coverage looks like across all layers. FINRA, the Financial Industry Regulatory Authority, has stated clearly that in virtually all cases when a brokerage firm ceases to operate, customer assets are safe and are typically transferred in an orderly fashion to another registered brokerage firm. The process is not instantaneous, and there may be a period of limited account access during the transition. But in the documented history of brokerage firm closures in the United States, the loss of client assets has been the rare exception, not the rule, and it has almost always involved fraud rather than simple business failure. It is worth walking through what an actual brokerage failure scenario would look like in practice, because understanding the process removes the fear of the unknown. If a major brokerage like Schwab were to enter financial distress serious enough to trigger insolvency proceedings, SIPC would apply to a federal court to appoint a trustee to oversee the liquidation of the firm. That trustee's primary legal obligation is the protection and return of customer assets. The first action in any such proceeding is a complete accounting of all client accounts and all securities held, and because those assets are legally segregated, they are identifiable, traceable, and returnable. In most cases, the trustee would arrange for the bulk transfer of all client accounts to a solvent brokerage, a process that in modern markets can be accomplished within days. You would receive notification of the transfer, your account would reopen at the new institution, and your holdings, your shares, your funds, your bonds would be exactly as they were before the crisis. The brokerage's name on your statement would change. Your portfolio would not. All of this is clarifying in theory, but I want to make it tangible. When you are sitting with a portfolio that represents 40 years of your working life, you do not need theoretical reassurance. You need to know specifically what would happen to the individual positions you hold. So let us walk through the 3 most common investment types for seniors and trace exactly what would unfold in a worst-case brokerage failure scenario.
Finance. Exchange. Traded funds.
If you own shares of a fund like VTI, VOO, or STHD, those shares exist independently of the brokerage that carries them. An ETF is a separate legal entity. It has its own structure, its own custodian, its own regulatory filings with the SEC. If Schwab were to collapse tomorrow, STHD would not collapse with it. The fund would continue to exist. Its underlying assets, the individual stocks it holds, would remain in the custody of State Street Bank, completely untouched by whatever legal and financial chaos surrounded Schwab's failure. Your shares in that fund would still be yours. In a managed transition, your account would most likely be transferred to a healthy brokerage, and you would find your holdings intact, perhaps carrying a different firm's name on the statement but identical in value and composition.
Mutual funds.
Mutual funds work under the same protective framework. Vanguard's own regulatory language is instructive here. The company explicitly states in its filings that the securities underlying its funds are held by a custodian and not by Vanguard itself. What Vanguard does is administer and manage those funds. It receives fees for doing so. It makes investment decisions on behalf of the fund, but it does not hold the assets and cannot reach into the fund to cover its own operating losses. The custodian holds the assets. Your shares of a Vanguard Total Bond Fund or a Fidelity 500 Index Fund belong to a legal structure that is separate from the company managing it, and that structure survives regardless of what happens to the manager. Money market funds. This is where the most confusion tends to arise, and understandably so, because the name sounds like something a bank would offer. A money market fund, the kind you hold inside a brokerage account as a parking place for uninvested cash, is classified as a security under SIPC rules. It is not a bank deposit. It is protected under the same brokerage asset segregation framework, not under FDIC insurance. The underlying instruments inside a money market fund are typically short-duration government securities and high-quality commercial paper, held by an independent custodian, and they do not disappear simply because the brokerage firm carrying the account runs into financial trouble. This is fundamentally different from a money market bank account, which is a deposit product and carries FDIC protection, a distinction that becomes important if you hold both types. There is one practical step I want every senior investor watching this to take, and it is simpler than it sounds. For any fund you own, any ETF, any mutual fund, you can find a document called the Statement of Additional Information, or SAI, filed with the SEC. This document will name the specific custodian holding that fund's assets. You do not need to read the entire filing. It can run to hundreds of pages, but a single keyword search for the word custodian will bring you directly to the relevant section. Reading that one passage gives you something far more powerful than reassurance. It gives you verified, documented, legally mandated knowledge of exactly who is safeguarding your money and under what legal framework. That kind of knowledge is not just comforting, It is the foundation of genuinely informed investing, and it takes less time than reading the financial news that caused you to worry in the first place. It is also worth understanding that your brokerage's creditors, the entities to whom Schwab or Fidelity might owe money in a bankruptcy scenario, have no legal claim on your investment assets whatsoever. This is a point that most people assume is true but have never had confirmed with clarity. If Schwab were to fail with outstanding debts, those creditors could pursue Schwab's own corporate assets, their office buildings, their technology infrastructure, their receivables, their proprietary cash reserves. What those creditors could not do, under any circumstances, is reach into the accounts of individual investors and claim shares of VTI or units of a Fidelity bond fund to satisfy corporate debts. The legal wall between corporate assets and client assets in the brokerage industry is not a procedural convenience, it is a hard statutory boundary that courts have consistently upheld. After everything we have covered, I want to give you the most honest answer I can offer, not the reassuring one, not the technically hedged one, but the genuinely honest one. The collapse of Schwab, Fidelity, or Vanguard is not a realistic near-term scenario. These are not regional banks running on thin capital with concentrated depositor bases. Vanguard manages over $10 trillion in global assets and has operated continuously since 1975. Fidelity oversees more than $15 trillion in assets under administration and has been in business since 1946. Charles Schwab has navigated multiple market crises, interest rate cycles, and competitive disruptions and emerged larger after each one. These institutions are subject to continuous regulatory oversight, maintain substantial capital reserves, and employ risk management systems of a complexity that is difficult to fully appreciate from the outside. A collapse of this magnitude would require a failure of multiple simultaneous systems that have never all failed at once in the history of American financial markets. And yet, and this is important, the right answer to the question of how worried you should be is not zero worry. It is calibrated awareness. The lesson of the 2023 banking crisis is not that the financial system is fragile. It is that different parts of the financial system carry different risks, and that understanding those differences is what separates the investor who panics at every headline from the investor who reads the headline, evaluates it accurately, and sleeps well regardless. What we learned in 2023 is that banks with concentrated depositor bases, poorly matched asset and liability durations, and limited capital buffers are genuinely vulnerable. What we also learned is that the brokerage industry operates on a structurally different model, and the risks that brought down Silicon Valley Bank simply do not apply in the same way to a Fidelity or a Vanguard. There is, however, one risk that no regulatory framework, no custodian arrangement, no SIPC coverage, and no amount of excess insurance can protect you from, and I would be doing you a disservice if I left it unspoken. If the economic conditions severe enough to bring down a major brokerage ever materialize, the same conditions would almost certainly be devastating to the value of the investments held inside that brokerage. Your shares would survive, your ETFs would still exist, but the prices of those assets would reflect the reality of the economic environment that had produced the crisis. That is market risk, the oldest and most unavoidable risk in investing, and is precisely why asset allocation, diversification across asset classes, and maintaining adequate liquid reserves outside equity markets matters as much as understanding institutional safety structures. The brokerage protects the vessel, your allocation strategy protects what the vessel is carrying. Before we close, I want to leave you with 3 practical questions, not rhetorical ones, but questions you can answer today with a phone call or 30 minutes on your brokerage's website. First, which of your accounts are brokerage accounts and which are bank accounts? And do you clearly understand which protection framework applies to each? Second, if you hold more than $500,000 in a single brokerage account, does your firm carry excess private insurance above SIPC limits? And have you verified that coverage in writing? Third, for the major funds you own, have you located the statement of additional information and confirmed the name of the independent custodian holding those assets? These are not questions born of fear. They are questions born of responsibility, the kind of informed stewardship your retirement savings have earned after decades of being built. I want to add one final thought for the investors among you who feel, even after everything we have covered today, a residual unease about having all of your assets concentrated at a single institution. That feeling is not irrational, and acting on it thoughtfully is not paranoia, it is prudent risk management. Spreading significant assets across 2 or 3 of the country's largest, most regulated brokerage firms is a perfectly reasonable strategy, not because the collapse of any one of them is likely, but because concentration risk in any form deserves to be managed deliberately. The same discipline that leads a wise investor to diversify across asset classes can reasonably be applied to diversifying across custodial relationships. Doing so does not reflect a lack of confidence in the system. It reflects precisely the kind of careful, eyes-open financial stewardship that has always been the hallmark of investors who sleep well at night regardless of what the headlines say in the morning. The American brokerage system, for all its complexity, was built with the protection of individual investors at its structural core. Asset segregation, independent custody,